Welcome, everybody. Welcome to Hidden Truths again. Today we have Bob Barone, our host, who is going to speak about the housing market. Hi, Bob. How's everything going today?
Everything is wonderful except for the housing market.
Except for the housing market, for sure. Well, you've written extensively about this, right? So can you bring us up to date as to what's going on really in the housing market and what you see happening over the next few months?
You know, housing is a really important contributor to GDP. And the rapid rise in home prices over the last few years has been a major issue in housing, well, until recently. Now, the rapid rise in home prices isn't the issue anymore. It's a rapid rise in interest rates. And that's become the major culprit in the housing market. Housing is now the least affordable it has been in over 40 years, and that drives all kinds of people out of the market. Mortgage rates on a 30-year fixed basis are now above 6%. At the end of last year, they were below 3%, and that's the major reason why buyers have been priced out of the market. Mortgage purchase applications, these are for purchases of new homes, continue to fall on a week-by-week basis. As of September 9th, they are now 64% lower than a year ago. That's big. They can't buy houses. What happens to the prices? Well, the prices have stopped rising. Everybody knows that they've been rising really rapidly for the last few years, but we think that we're just at the beginning of a correction process in housing prices. And that, again, depends on how high interest rates rise. And that's a function of what the Federal Reserve is going to do. But anyway, we believe that what we will eventually see over the next year is a correction in housing prices in somewhere between the 10 to 20% range. And maybe even more depends on if the Fed continues to keep raising interest rates. We note that in Canada, and Canada's had a similar price run up to the US, they've already begun the correction process in their housing prices. Over the last 6 months, housing prices there are down at a 7.5% annual rate. And in August alone, they were down over 1.5%. In Australia too, home prices are now deflating. And in Australia, they're deflating at the fastest pace since 1983. The Federal Housing Finance Agency has a home price index. And while it did rise very slightly in June, that's the latest data that we have, the rise there was much softer than in prior months, only 0.1%. And in fact, the median price of homes in that index fell almost 0.5% in June. July and August, we think, are going to be negative for both of those statistics. That is for the rise in the index and for the median price. Case-Shiller has a set of indexes. The 20-city composite index shows a fall in year-over-year prices in both May and June. That's the latest data that we have. And Redfin says that 21% of homes for sale in July lowered their asking price. So that's a big statistics. And that's the highest rate since Redfin began tracking that kind of data. And that's in 2012 when they began. So it's been 10 years. It's the lowest in 10 years. And Zillow also does a similar report. And for Zillow, home prices actually fell 0.3% month over month in August. So we think these signs of home prices that I've just mentioned are an early sign of things to come, and that we will see much more severe home prices contract in the coming months.
We are in a very different environment as far as the housing market is concerned. Any other issues in housing that you can foresee coming?
Yes, in the new housing area itself, there's excess inventories now. This is for new houses. These are for the home builders. And the reason we have excess inventories is there's been a very rapid slowdown in the sale of new homes. We see fewer prospective buyers and we see cancellations, and those cancellations are the highest since the COVID lockdowns began in 2021. During this last few months, the number of months of inventory has skyrocketed. view this by looking at how many sales they have and how much inventory they have and dividing the two and coming up with a month's supply of inventory. Just a few months ago, that number was 3 months. So they only had 3 months supply of inventory. The latest number is 11 months. And just for clarity, normal is 6 months. So we've gone from a very hot market to a very frigid one in just a few months. In July, new home sales fell almost 13% on a month-over-month basis. And that was in July. In June, that number was minus 7%. So over a 2-month basis, May, June, and July, from May through July, we're just a hair's breadth short of a fall of 20%. On a year-over-year basis, when we compare what we were doing a year ago, sales are down 30%. And they're falling at a 60% annual rate on a year-to-date basis. So that's huge. These are big numbers in the housing business. The home builders have what we call a sentiment index. This is an index for the home builders themselves and their views about what's going on in their industries. It's a scale of 0 to 100, and anything above 50 is positive, anything below 50 is negative. In August, the index was 46. It was 49 in July, both negative. And this is the lowest it's been since 2012. And just for comparison, back in January, this index was 83. So that's just in 7 months, that's quite a drop. And no wonder. Toll Brothers, America's largest luxury home builder, says its order books are now contracting, have now contracted 60%. That's really big.
I know there's a huge shift taking place right now. Well, is the market for existing homes doing any better?
No, not really. Existing homes fell in July almost 6%. They're down 6 months in a row, minus 20% year over year. That doesn't sound like a big number, 20%, but that's huge when you come to think of how many houses are sold. And the rising prices, as I said earlier, have now begun to soften. Pending sales, these are new contracts that are signed. They fell 1% in July, and they fell 9% in June. That's nearly 10% in June and July. That's down big time. And they've been down in 8 of the last 9 months. On a year-over-year basis, they're down 20%. And so this is quite significant. The worst appears to be on the horizon, because if we look at mortgage applications to buy existing houses, they've been down week over week over week, and are now down almost 30% year over year. And if we just exclude the COVID lockdown period, this is a 22-year low. Redfin is an agency that does reporting on this kind of stuff. They indicated that in July, 21% of homes that were listed with realtors dropped their asking price. That's a first time in a long time. That's the fastest pace since Redfin began its survey in 2012. Now, let me talk about refis. These are applications to redo your mortgage, in effect. Home prices rise. People have what they think is equity in their homes. It's a source of liquidity for American households. And it has been a source of liquidity until recently. These rates are down 83% year over year, these refi apps. Now, people use the money they get from their refis to do things like buy a car, or maybe to redo their kitchen, or add a swimming pool, or go on an expensive vacation. But this has all gone away. So people aren't going, because interest rates have risen, they can't afford to make the mortgage payment, so they don't borrow. And they probably have a lower mortgage rate, so they don't want to refi to get a higher rate. So all of it just stops. And that means that they won't be able to add the kitchen or the swimming pool or go on an expensive vacation. So that's significant.
New data out today shows that housing starts risen, but that new permits fell, right? What does this mean, really?
The rise in housing starts, that was, you scratch your head, say, well, Bob, I thought you said the housing was not doing well, and yet we have a rise in starts. Yes, it was all centered in multifamily apartment starts. So just think about this. With the rise in interest rates and people can't afford to buy single family homes, if they start a new household, what do they have to do? They have to rent an apartment. So apartments have been in demand because of this phenomenon. Over the past year, apartment rents have risen. The number was 6.3% year over year for August. Over the past few months, builders have gotten permits to build multifamily because the rents were going up and there was going to be a lot of demand for them.
Yeah.
But they weren't able to start those apartments because they couldn't find the building supplies because of the supply chain issues. Now, the supply chain has eased up and they can get the building supplies. They've already got the permits, so they started building them. So that's why starts rose. The bigger story here was that permits, these are applications to the government agencies for permits to build housing. They fell whopping 10% in August. For single family homes, the permits fell 3.5%. For multifamily, they were down 18.5%. The rise in starts and housing starts in August was clearly due to the easing of the supply chains and the availability of building materials. And it is not a sign of a pickup in the building industry. The sign is permits are down big time going forward, and looking down a few months, we're going to see much, much lower building in the US.
Quite a change in just a few months, quite incredible. What's the takeaway from all of this, Bob?
Unfortunately, the Federal Reserve is set to raise interest rates again this week, and likely we're going to see them raise them again in November and December. And so every time they raise them, it makes it worse for housing. So housing is in for a pretty rough ride. We see that the home prices have fallen in Canada and Australia, and that will soon be the case here in the US. As I indicated earlier, Zillow reported that home prices in their index declined in August, and it was the largest decline in their index since 2011. We'll also note that, as I said earlier, home builder sentiment and their order books have sagged. The only logical conclusion we can reach is that we're just at the beginning of a housing recession, and I think it's going to be a pretty significant one.
Well, this is what you have predicted for a while now.
Yes.
Coming with the deep recession in general, right?
Yes.
All right. Well, it was great information as usual, Bob. Obviously, like I mentioned before, quite a shift and quite a change in just a few months. It just tells you you never know what to expect, and it is wise to watch your expenditures, your expenses, and what you take out as loans.
Yes, we're in for a recession that I think is pretty inevitable.
Yeah. Great. Well, thank you so much, Bob. For everyone, go to Hidden Truths that today we have all our videos and all our podcasts there. Also subscribe to the YouTube channel. There's a lot of very valuable information that both Bob and Josh record every week for you. They give you information that can be really important for where you invest your money. And of course, they are there to guide you with your investments. Thank you again so much for watching, and see you next time.